your low cost entry to multifamily. In this one, we're going to dive into that way to do that, and it's multifamily house hacking. So, what is multifamily house hacking? So, multifamily house hacking is basically when you buy a 4 unit and under property. So, that could be a 2 unit, 3 unit, 4 unit, and you buy it and you actually rent out the other units and live in one of the units. And since you're living in one of the units, you can get a different kind of loan with a lot less money down, which we'll touch on further. But basically, you buy the property, you can get in for less money. You live in one of the units. Preferably, you buy properties you can renovate a little bit. But it allows you to get into multifamily and also limit your living expenses, cut your living expenses back because the other tenants will cover most. If you buy it correctly, the other tenants will cover most of your living costs. And it's a great way. So it's a great way to get into your first property and then start saving a bunch of money, cut down your expenses, so you can buy more properties and you need less properties then to get into financial freedom. So that's what multifamily house hacking is. Let's kind of dig in. So here's a house hacking example. Here's a 4 unit property that I pulled. So let's say you pulled your list of 4 unit properties in your area that you wanted to target. You used some direct mail. You mailed to the owner of this property, and they gave you a call. They're motivated. They're interested in selling. They no longer want to hold the property for whatever reason. So they're entertaining an offer. You speak to that seller or that owner about the property. You get the details for the property, and then you go agree to a price for this property for $250,000 with that owner. So just in the general for the property, it's a 4 unit property that we're going to cover. The units need some updating, so you'll bake in some renovation costs. Your plan will be to renovate the units, move into one of the units like I discussed, and then renovate or rent out the other three. And then the other three tenants, the income that you get from that rent will cover a lot of the expenses, and hopefully eliminate most of your closing cost or your living costs. And then you'll want to hire a property management company as well. You can do this by managing it yourself, but I always think it's better to leave that to a management company. They can handle managing the other 3 units. The other units can just see you as another tenant and not the landlord. That way they're not bugging you. That way they're not calling you for maintenance requests. You have a property management in place that'll handle that kind of stuff. So you kind of just look like another tenant living in the property. They don't know that you're the landlord. It saves you from a lot of different issues than doing it that way. That's what I would recommend. So here's the letter, and then the letter led to motivated owner, and then you're purchasing the property right there. So just digging into the numbers, how the numbers would look if you do house hack a property. So purchase price you agreed on with the motivated seller of $250,000. We'll say that there's $50,000 in renovation costs for the units to update the units that you need to do, bringing your total to $300,000. And what you can get now is you can get a FHA 203K loan, which is a loan that basically wraps in. It's not just for the purchase price; it wraps in the unit renovations, any sort of upgrades that you're going to do. Like I said, you can get into it for low down, so you can get into it for only 3.5% down. So your loan amount comes out to $289,500. So that's 96.5% of that total 300 with the renovation included. You figure down payment comes out to at 3.5% comes out to 10,500, and then you figure in some additional closing costs of 4%, and you're looking at an all-in investment of 22,500. So you're getting into basically $300,000 worth of property for only $22,000, which is really great all in. So you can get in a little bit cheaper than you would if you're buying it with a loan that you're going to have to put 25% down plus the additional closing costs. And you don't have to bring the renovation costs because those are also wrapped into 203K loan. And that 203K FHA loan is a 30-year loan, just like your traditional 30-year mortgage that you would get. For this example, we use 5.5% for the interest rate. So if we break down the financials for the income, apartment one, after you renovate, you buy the property, you renovate it. Apartment one is going to get $900 a month. Apartment two, $1,100 a month. Apartment three, $1,050 a month, and then apartment four that you could probably rent out for let's say $1,200. That's going to be your unit, so you're not going to get any income from that. You figure a vacancy cost of 5% on that annual rent that you're collecting, and this will be a little bit lower because you don't have to account for the vacancy of your unit. because you're going to be living in it and you're not going to be moving out of it. So you don't have to worry there. So the income vacancy is going to be a little bit lower than it would be for a traditional 4 unit property, and your gross income would come out to $34,770 per month. And then when you break down expenses, you got taxes. So $5,500 for taxes, $1,500 for insurance. Property management will be, like I said, hire the property management. That'll be 10% of the income that they collect. So that'd be $3,477, and that's a traditional property management cost with, um, their fee for what they collect. If they place tenants, they usually take first month's rent, that kind of stuff. So if you bake all that in, it usually comes about 10% as a good figure. Maintenance, $3,200 a year. CapEx, so this would be for large items. So like if you want to budget for this, so when your roof goes bad, your HVAC unit goes bad, you're budgeting monthly for this, or yearly for this, so that you have that money already there when something goes wrong and you need to replace it. So 1,600 for that, basically 400 a unit per 400 a unit. Utilities 6,500. So this would be the landlord for you covered utilities 6,500. Lawn and snow, let's say it's 500. If you're not doing it yourself, you could easily do that yourself, save a little bit of money there. But we'll just say that you're paying somebody or having somebody to do it. And then any other miscellaneous expenses that could be like borough costs, specific, township costs, some sort of admin, legal stuff, that kind of stuff. So your total expenses come to 22,527 for this example, bringing your net operating income, which is the income minus the expenses, to $12,243 a year. The monthly mortgage for that loan that's 289,500 at 5.5%, 30 years, comes out to 1644 a month. So you're paying an annual mortgage of $19,728 per year in mortgage, which actually gives you a negative cash flow of $7,485. So on the surface, that looks bad, but you got to remember you're house hacking this, so you're losing 1 unit of rent, which would have put you in the positive, and you got to also take into account why you're doing this. You're doing this also to cut your living expenses. So if you look at your living on the right there, then you get your living expenses. Let's say before you bought this house hack, you're living in an apartment, you're paying $1,300 a month, and then another $400 a month in utilities. That's $1,700 a month that you're paying in just, let's say, living costs that would be associated or cleared out with the house hack. So your annual living expenses come to $20,400 per year. And the house hacking costs, so you're paying into this house hack because of the negative cash flow, $7,485. So you're actually end up in the long run saving almost $13,000 a year in living costs by moving into this house hack. And then the great thing would also be is, the property will go up in value. You'll increase your wealth there, build equity. But then when you want to move out the property, maybe in a year or two down the road, when you rent your unit out for $1,200 a month, let's say, that's going to put you into the positive cash flow. So this will be a cash flowing property. So it'll be producing income once you move out. So you'll be able to live there cheaper, save more money so that you can invest in more properties, build a savings that you can invest in more properties, and also cut your living expenses so you don't stress as much. And then when you do move out, you already have your 4 unit cash flowing property. So this is the best way to get in. This is the fastest way to get yourself to financial freedom by cutting your living expenses, saving more, and getting into your first multifamily property. So this is what I recommend. I recommend house hacking for anybody that's getting started because it's just a quicker way to get you where you want to be.